So in the previous session, we had a bit of a conversation about where agriculture was going and our expectations for this year and into next year. And as I mentioned, we're expecting the gross value of agricultural, fisheries and forestry sectors to hit $98 billion in 25-26, which in nominal terms, if we realise that's the third highest on record. So coming off the back of a big step up on this year, a continued, consolidation as we go into next year. In this session today, we'll have the opportunity to really kind of unpack that number. It's a big number, a headline number, and get into the industry detail that really lies beneath and what's going on. And I'm lucky to be joined on stage with excellent, talented and very intelligent people who come up with our forecasts and really know the markets and their area of expertise and bring together the work that ABARES does and brings together our ability to make comments and to put forward some of that robust and independent data and analysis on the sector. What I'll do is I'll introduce everyone as we kind of go along and then we'll have a bit of a conversation. I'll kick us off by asking the first question, but please make sure that you're entering questions into the app and we'll kind of go through them as we then go through the analysts. So if you think of something, don't delay, jump in and put it in, and then we can be ready to roll when we open up to Q&A. Emily, now we've experienced a few ups and downs and highs and lows throughout the season in the cropping sector, but nationally we're expecting another big year. Can you walk us through what you think, the factors that shape this year and what factors will be influential as we look to 25-26?
Yeah, absolutely. The 2024 winter cropping season in Australia shaped up to be a pretty exceptional year. An excellent start to the season, as well as above average rainfall in major cropping regions of Queensland and New South Wales, saw winter crop production increase in both states. And for New South Wales, production increased to near record levels, while production in Queensland more than doubled to reach a new record for the state. As for WA, despite a dry start to the season and what ended up being below average in-season rainfall, crop prospects improved significantly following timely winter rainfall, and this saw production increase. Yields were much better than expected, and production for WA has ended up being around 23 million tonnes, which is the third largest on record. Now, the season was not without its challenges, and dry conditions throughout the season for both South Australia and Victoria saw winter crop production fall to below average levels. Jared, when discussing the 2024 winter cropping season, I wouldn't be able to discuss it without also mentioning pulses. So we typically refer to the big three crops being wheat, barley and canola, but for 2024 it was more like the big five, including both chickpeas and lentils. So overall, the total area planted to pulses came in at a record for the year. Chickpea production increased to a new record, and that was because of the improvement in seasonal conditions across the major chickpea producing regions in Queensland and New South Wales. And so higher yields as well as a significant expansion in area. And the area increase was in response to higher prices following India's announcement of a tariff-free period for chickpea imports. And at the same time, the tariff-free period for lentil imports was extended. So this saw lentil plantings increase in the major lentil producing regions in South Australia and Victoria. However, production ended up falling year on year, and that was because of lower yields and drier conditions in the two states. So overall, winter crop production for 24-25 has ended up reaching around 60 million tonnes, and that's the third largest on record. And despite below average in-season rainfall for some of those major cropping regions across Western Australia, Victoria and South Australia, we have noted, and we've been hearing a lot of feedback from industry, that yields were better than expected. And this can be attributed to a range of factors. For instance, improved farming practices that conserve soil moisture. Also, a bigger focus on soil health and soil amelioration. And along with that, advancements in seed varieties. So because of these factors, we're seeing a really positive trend in Australian crop yields. And with that in mind, our higher production for the year now lifts our 5-year average for total national winter crop production to be the highest it's ever been. So taking wheat as an example, prior to 2020, there was only 1 year that the national Australian wheat crop exceeded 30 million tonnes. The 5-year average is now sitting at above 33 million tonnes. And that's with 4 out of the 5 years exceeding 30 million. So some really big increases and some phenomenal results. And this higher production volumes are also driving higher production values. And that flows through to high export earnings for Australian crops as well. So for 2024-25, the total volume and value of exports for grains, oilseeds and pulses is expected to remain well above average. Now, I guess looking ahead to the 2025 season, we are forecasting that crop production will fall year on year, and that's because of an expected return to more neutral conditions. But having said that, total production is also expected to remain above average. So stored soil moisture levels across cropping regions in New South Wales and Queensland are expected to benefit winter crops. In Western Australia, winter crop production is forecast to remain above average, and this will depend heavily on in-season rainfall, given the soil types in Western Australia don't tend to retain soil moisture in the same way as soils in eastern states. And for South Australia and Victoria, with an expected return to more neutral conditions, we are forecasting a major improvement in crop production in both states. So with that, overall, national winter crop production is expected to remain above average, and with that, we're also expecting above average production values. So Jared, certainly some positives for the year ahead.
Oh, wow. Thanks, Emily. It's quite a story really of our grain sector, and you see some of the flow through of that high productivity levels we were talking about in the grain sector before. And that's an amazing figure, that wheat average production over the 5 years. So.
Yeah, you might be interested to know that our forecast for 2025-26, we're forecasting wheat production to reach around 30.5 million tonnes. So well above the 10-year average. Yeah.
It's incredible. Excellent, thank you. So we're going to stay with plants for the time being, and we're going to move on to Fred Litchfield, who has both wears our macro hat as our macro analyst, also has been looking after horticulture and wine. And I think we can all agree that interest rates have driven most of us to want to drink recently. And so I think we've quite well paired these two different commodities. Now, Fred, there's, I guess, a lot been going on in wine markets in particular, a lot of turmoil. We've seen trade disruptions, but we've also seen exports, I believe, come back to China worth about $1 billion. Can you tell us what's going on in the wine market? Because there's more to this story.
Yeah.
And also maybe what's going on for horticulture more generally.
That's exactly right, Jared. We have seen wine exports to China reach $1 billion since trade restrictions were removed about 12 months ago in late March. And that's a fantastic result. But as you sort of alluded to there's a little bit sitting underneath that perhaps isn't quite so rosy. And that's primarily driven by, over the last 10, 15 years, declining global wine consumption in pretty much all established markets, particularly China. What we're seeing there is that's primarily the case in the younger population, the rise of health-conscious consumers. And then the other thing that's weighing on consumption at the moment for wine is just cost of living. And that's impacting consumer confidence and spending in many markets, and particularly some of our key export markets in the US, the UK, and China. Nevertheless, Australia's brand remains really strong, particularly for our cool climate premium wine. The other thing as well, I think worth mentioning on wine is, although we have seen a little bit of a reduction in global supply over the last few years, as some producers in South America, France, Italy are actually removing some of their vines, just due to the fact that consumption has been declining and the prices aren't there. Supply is still pretty strong though on the whole across the world, particularly for red wine, and that is weighing on some of our exports. Switching over to horticulture, which is, we're forecasting to reach a total of $19 billion in 25-6. Exports have also been really strong. We're forecasting a record this financial year and then again next year. Over $3 billion for fruit and nuts. It's a great result. And driving that has been really strong production and export volumes. So we've seen over the last 12 months pretty favourable growing conditions on average across Australia. Now that's on average. We know that there have been some pretty strong localised impacts in some regions. We've also seen really high water availability in general, which is very important for our irrigated horticulture. And then we've also seen increases in bearing area over the last few years really come to fruition now. Partially offsetting the rise in production and volumes is a little bit lower global prices, and that's primarily due to really strong global competition in the fruit and nut space out of South America, the US, and that does weigh on exports a little bit. But again, the Australian brand remains really strong, particularly in our key markets in Southeast Asia, Japan and Korea. Yeah, thanks.
Excellent. Thanks, Fred. Yeah, we're seeing kind of consistent and longer term growth in the horticulture sector, and we know that we talk about horticulture a bit, and there's different dynamics at play based on whether you're trade exposed or whether you're domestically focused and so forth. But at a sector level, as Fred points out, it's been quite a positive story, and it's good to see some, I guess maybe some positive changes for wine, which has been quite embattled over the last few years. We're going to change tack now and move on to livestock, and it's been a big year for red meat exports over across the board, and we've also seen quite a number of movements in livestock prices, and I feel I always talk about livestock now quite a bit recently. So we have Gaby Coulthard here with us, who heads our livestock team. Now, Gaby, we've been hearing a lot about livestock markets that I mentioned, and we talk a lot about livestock markets. There's a bit going on with the US herd, but what's been driving livestock markets and exports recently, and what might we expect when we go into 25-26?
Yeah, thanks, Jared. As you just touched on, the red meat exports was actually the highest on record in 2024, with record volumes of lamb, mutton, goat, and beef. So for 2024, not only to established markets in the United States, but also more emerging markets in the Middle East. We've also seen cattle and sheep sale yard prices rise in 2024 off those lows we saw in 2023. And this has really been driven by three key factors. So increased processor demand at sale yards, rising processor capacity, as well as that strong global red meat demand. And looking at that global red meat demand in mind, we are forecasting that the livestock sector will increase in 25-26, with the value of production to reach $40.3 billion, which actually would be the highest on record. And that's largely due to those higher sale prices across sort of quite a few livestock commodities. Looking more at an industry level, looking at sheep meat and beef, we're forecasting that the value of production will rise in 25-26, driven by those higher sale prices, offset a little bit by what you touched on earlier today about just a small decline in production for both sheep meat and beef. We've seen a sort of exponentially high production levels in 23-24 and 24-25. So we're just forecasting production to come off a little from that. Looking globally, US demand for beef and veal is likely to remain really elevated. In 2024, the US value of exports was $4.4 billion, so it's quite a large sector. We're likely to see that increase as well. Also, interestingly, in 2024, the Middle East actually overtook China as Australia's highest value sheep meat export sector. So that's also something we're likely to see increase the Middle East. Not only demand for mutton, but also lamb as well. We've seen a lot of demand for sort of prime lamb cuts out of the Middle East. Looking more domestically, We've seen good summer rainfall over eastern and northern parts of Australia, and this sort of combined with the neutral climate outlook we have for 25-26, we're likely to see pasture availability increase, and therefore this will result in increased restocker demand at sale yards, therefore driving up prices. Price is obviously a big story. Looking more at the dairy market, we are forecasting that the value of milk production will increase in 25-26 with an increase in farm gate milk prices, just slightly affected by and offset by a fall in milk production volumes, which we've seen over the last recent times. And we're also predicting that Australian farm gate milk prices will align more with the export prices. Lower feed costs will also have a big impact on livestock sector, with the value production of pigs and poultry to rise in 25-26, mostly driven by an increase in volume and a small decline in prices for pigs and poultry. So overall, Jared, the livestock sector is looking to improve in 25-26 off that increased strong demand we've seen, as well as a sort of diversification expanding of markets for Australian livestock.
Excellent. Thanks, Gaby. Yeah, so we've really seen that kind of consolidation going on in the red meat sector, which is really quite positive to see come out. Now, all these factors, particularly for our broadacre sector, the changes in both the output prices and production and then also inputs, and we went through a period where we started to see really that terms of trade where input costs were rising faster than outputs, and that started to squeeze broadacre farm cash incomes. And we've got Patrick Mulcahy here, who's from our farm performance team. And so I'm interested to know how these kind of various factors are playing out in terms of our changes in broadacre farm cash incomes. Patrick, could you kind of take us through what we think is our expectations around farm cash incomes, which I'm guessing I mentioned it earlier, which are pretty positive, but also where we think they might go to next year.
Yeah, Jared, thanks for that. We're sort of expecting pretty much improvement across the board for our broadacre farm cash incomes and profits. That really strong cropping performance that Emily's talking about and the red meat sector that Gaby's talking about is really driving increasing incomes and profits for both 2025 and 2026. Nationally, we think the average broadacre farm business profit will come in at about $110,000 for 2026, which is slightly above the 10-year average. And as you can see on that chart, it's really the cropping farms that are driving that big profit numbers that we're seeing recently, which is that blue line on top. As Em mentioned, the last 5 years have been some of the biggest cropping seasons we've had on record, and that's really been driving that improved average broadacre farm cash incomes and profits. Obviously, the 2025 results were a bit mixed. The New South Wales and WA areas, those big cropping regions, have really boosted cropping incomes, having had really good years. But areas like Vic and SA, as Emily has mentioned, were pretty dry and had it a bit tough this year. Moving to that more neutral 2026 forecast, that those areas like Victoria and SA are expected to improve, which will drive up incomes and profits. But coming off a dry base, it'll be interesting to see how much of that increase is realised. Those grey lines on the graphs there capture the climate risk in our forecast. And as you can see, the cropping farms in particular are a lot more exposed to climate risk than livestock farms. From the livestock side of things, beef continues to perform really strongly. That strong demand has continued to increase prices, which is more than offsetting the slight decrease in turnoff we're expected to see, which is pushing revenues up and continuing to see profits and income rise. From the sheep side of things, in 2025, the sheep industry is probably a bit more exposed to those really dry areas we saw in Victoria and SA, which has weighed on profits for 2025. But with improving conditions, improving sale yard prices, we are expecting profits to improve for 2026. While costs are expected to cool, they do still remain elevated. And with mutton and wool prices still being a bit subdued, the average broadacre profits for sheep specialist farms is expected to come in below the 10-year average still. On the cost side of things, there has been a bit of movement, Jared. We're expecting our total cost to come down for 2026, with some of the prices coming off and a bit lower production. removing some of the volumes of those input prices we need. Interest rates are coming down, which will help provide a bit of relief from the interest cost side of things. And fuel and fodder are also expected to come down quite a bit, for 2026. Some of the other costs like fertiliser, chemicals, labour and services are still expected to rise a little bit in 2026, but the growth is easing a little bit. So overall for 2026, Jared, we're expecting a pretty good year. Average incomes and profits to improve, given that stronger production, improving sale yard prices and cooling costs.
Awesome. Thanks, Patrick. Yeah, so points to still a bit of a differentiation across our sectors, but good news on the input side. But I guess the message is still prices for some of our inputs remain elevated, and still a tough time for sheep specialists given what we see in mutton and wool prices. We're going to shift a little bit further away from land and into different waters, use a bad pun, and going beyond and looking at our fisheries and aquaculture sectors, which make up an important part of the overall primary industry bundle and also an important part of the work that we do here at ABARES. And for fisheries and aquaculture products, they're not too dissimilar to our other commodities, exposed to international markets, also exposed to domestic economic changes and fluctuations, and we're also, as mentioned earlier, there's the other aspects like climate and so forth playing a role. I'm joined here by Harrison Tuynman from our fisheries economics section. So, Harrison, what are some of the major watch points when we think about the fisheries and aquaculture sector as we look to next year, and what are our expectations around industry performance?
Thanks, Jared. Yeah, as we approach the 25-26 period, the renewed access for rock lobster to the China market, coupled with strong demand for salmonids, it's expected that the value of fisheries and aquaculture will lift to over $4 billion. For rock lobster in particular, the renewed access to China market is driving producers to shift towards live exports as opposed to frozen, where it's the live's commanding a price premium. From this, we expect prices to rise 20% this financial year, and at least a further 10% in the next. With a steady allowable catch, the real value of rock lobster will peak around 26-27 at approximately $600 million. For salmonids in 24-25, production value is forecast to rise, driven by both larger volumes and higher farm gate prices to around $1.3 billion. For exports, with most salmonids destined for the China market, rising at-home consumption and expanding fresh online delivery services in China will raise export value to around $400 million, which is currently being aided by a weaker Australian dollar. And which is substantial. Like 10 years ago, the salmonid export industry hadn't breached 100 million. And Jared, the growth of aquaculture salmon industry probably has been the leading story for Australian seafood over probably the last 2 decades, and has really buffered the sector against a declining wild catch value. We expect growth to continue, adding at least 10,000 tonnes in the forecast period due to expansions in regions like Storm Bay, Tasmania. And as a trade-exposed sector, with exports representing roughly 40% of the GVP value, the seafood industry does remain sensitive to exchange rate fluctuations, and a depreciating Australian dollar could reduce our export competitiveness. Looking ahead to 29-30, most seafood commodities are likely to experience a declining real price, with rock lobster being the notable exception due to its strong position in the China market. Other species do face a mixed outlook. An oversupply of abalone in China is keeping prices low, while increased prawn supply from places like Ecuador and India exerting downward pressure on global prices, particularly for the types of prawns Australia likes to export. Although tuna production is expected to grow with a higher allowable catch, we do expect prices to decline slightly as consumers, particularly in Japan, shift their preferences towards other land-based proteins. So while the overall outlook does remain positive, risks do persist, particularly with the volatility of global trade markets and tensions in general, which could impact prices in key export markets. And aquaculture is being considered a sustainable solution to meet seafood demand, but will be under increased scrutiny and changing licence to operate requirements. Still, the diversification of Australia's aquaculture systems is expected to continue, with prawns, barramundi and Murray cod likely to grow. Finally, across the entire seafood sector, climate change does remain a key risk. It's an unpredictable factor, with the long-term impacts on seafood systems still really being assessed. Despite this, Australia's seafood industry has proven resilient in the past, and it's well placed to meet these challenges.
Excellent. Thanks, Harrison. And I was about to say, I remember it wasn't that long ago that aquaculture took over the wild harvest in terms of value, but then I looked at your chart and it was longer ago, so I'm feeling a little bit old. But it's quite an interesting story, in that growth that we've seen in aquaculture is really a kind of an area of growth for fisheries, but also an area of growth in exports and the like. And the other thing you touched on, which I think is an interesting story for those who want to look up, is the sustainability story around tuna, and how science-based decision-making really improved the outcomes, and we're starting to see the dividends start to flow through in terms of production and exports and livelihoods and so forth. But enough of that. Moving on to our other primary industry, which is an important part of the Ag, Fish and Forest bundle. And finally, I'm joined by Stephanie Black, who heads our Fish and Forest Economics program, who's going to talk to us about forestry. Now, forestry has much longer production timeframes than all the other commodities we've just been talking about, but it does play an important role in the overall performance of our Ag, Fish and Forest sectors. Now, in recent years, we've seen the sector kind of ride the wave of, I call it the timber wave of domestic economic conditions, post-COVID in particular. But what are some of the developments that we're seeing in our forestry markets, and how do we think that these are going to play out and influence sector value?
Okay, so thanks, Jared. Now, as you know, when we talk about forestry, it's important to recognise that we have three distinct market segments that play very different roles in Australia's economy. We have Australia's softwood plantation estate, which is the main supplier of timber to our residential construction sector. We have our hardwood plantation estate, which is a global supplier of wood chips to the international market for paper and packaging manufacturing. And we also have the native forest estate, which is a supplier of high quality, high value saw logs for appearance and structural grade applications that are quite sought after by Australian consumers. Now, Jared, as you alluded to, the forestry sector, one of the perennial challenges for the forestry sector is the very different time horizons for decision making. So on the one hand, demand for forest and wood products is heavily influenced by immediate and near-term economic conditions. And the housing market is a prime example of that, but so too are global markets for paper and packaging products. On the other side, it takes a much longer time period to grow a tree. We take up to 25, even 50 years to grow a tree that is suitable to produce a saw log for a structural application. So it's that time differential that makes it quite difficult to talk about forestry in the same way as we do grains, for example, that are planted and harvested annually. For the forestry sector, what we know is that in the short term, and for the forestry sector the next 5 years is the very short term, we're expecting to see a number of pressures. The housing market conditions are affecting demand for Australian softwood saw logs. Our values of Australia's softwood plantation harvest are based on the construction sector activity numbers as published by the Housing Industry Association. What we're seeing is that HIA is projecting an uptick in construction activity over the coming years, as there appears to be more certainty around interest rates, giving confidence to the market. But for the forestry sector, there's going to be a very important watch point as to how that construction evolves, particularly across detached housing or multi-storey, high-rise, high-density apartment developments. This is because detached houses, and in particular double-storey houses, use a lot of timber, whereas apartments do not. So then when we move across to the hardwood plantation estate, the major driver of value for our hardwood plantations is the international wood chip markets. So Australia's hardwood plantation wood chips are known to be high quality, high value, and historically they have been a high export earner for Australia's plantation sector and for the forestry sector in general. But since the COVID pandemic, we have seen a shift in international wood chip markets, and Australia is starting to face increased competition from countries such as Vietnam that are able to produce wood chips at a lower price point than Australia. So in the short term, we're expecting that a low Australian dollar will help support our export earnings and keep us competitive in the international market. But as the Australian dollar starts to appreciate again in the outer years, we are expecting to see a bit of a pullback in export earnings. Now, finally, for the native estate, Australia's commercial native harvest is determined quite heavily by state government regulations and access to multiple use native forests. What we've seen in the last 2 years is Victoria, Western Australia and Queensland make quite large changes to access arrangements to commercial native forestry. So our projections of the native forest harvest going forward are based on an assumption that current access arrangements will remain in place, as well as our understanding of how Australia uses the harvest from our native forests. So across those three market segments, we do also have the carbon market operating, and we have a number of government policies and programs focused on the forestry sector, including the support plantation establishment grants. So in the past 2 years, we have seen an uptick in plantation establishment in Australia, particularly in the softwood plantation estate, which is the supplier to our residential construction sector. However, we're not expecting to see the impacts of those new plantation establishment on the market for at least the next 14 years as these plantations go through their first thinning operations. Even then, that first harvest will be pulp logs, so it won't be for structural applications. We need to wait another 20 years from now till we get our first harvest of saw logs, and even then it will be a small proportion because it'll be a second thinning operation. We actually need to wait about 30 years for these plantations to be harvesting their major crop of saw logs, which I guess brings us right back to where we started, Jared, that the forestry sector works on very different time horizons.
Yeah, thanks, Stephanie. It's quite amazing, really, like that. We talk a lot about, supply and demand for timber now, but the decisions made to supply timber now occurred, 20, 40 years ago. And so balancing, and trying to get a handle on what demand might be in the future, and balancing the vagaries of domestic economic conditions as we go through is a tough one for the sector. But as we can see, the sector's still got some good prospects ahead as we look through. So thanks very much for that. So now I think we can move on to the Q&A aspect of the day, and I might just grab one of my team to come up and see if they can sort out the Q&A laptop. But being a fan of actionable options, I've also got it on my phone, so I can carry on as we go through. So the first question will go to you, Emily, and it's around some of that, story around chickpeas that we've seen, and we're seeing a bit more of a trend. Well, in recent years, we've seen that farmers take advantage of the market. But there's potentially some other aspects of growing chickpeas and lentils and so forth as a nitrogen-fixing crop. Do we see, a more longer-run role of this becoming our top 5 rather than the top 3 as we look forward? Whereas, when we think about ESG and emissions?
Yeah, thanks for the question, Jared. So thinking about chickpeas as well as lentils, we've seen that there had been this really great opportunity, I suppose, for Australian growers to increase their plantings of chickpeas, and that it also provides major agronomic benefits as well, like you mentioned. I think maybe rather than thinking of it as the big 5, we could even suggest, say, the big 4, because we are hearing that lentil plantings in 2025-26 are expected to increase, especially in South Australia. And this is mostly because of high expected returns relative to other crops. So noting, for instance, that the production costs are higher for other crops like canola. And it's also been found with the year that they've had in South Australia that lentil crops actually performed rather well under dry conditions. So that also provides an opportunity where for grower decisions that lentils are becoming a much more important crop in the overall makeup.
Awesome. Thanks, Emily. I mean, it's an interesting dynamic that I guess markets can create. You know, we talked about this morning about new ideas and applications of new ideas and then how that flows through to productivity. And so there's potential, I guess, spillovers from market access to drive and competitiveness and this kind of virtuous circle that we're talking about. Turning, you know, of course, from chickpeas to aquaculture, natural segue. Just wanted to, I guess, go beneath maybe, Harrison, some of that big change that we've seen in aquaculture over time. It's shown tremendous growth over the last couple of decades. What do we think are, like, for aquaculture, specifically some of the kind of opportunities and challenges for that element of the industry?
Yeah, definitely. You know, I think when you think about aquaculture, it is and will be an important part for meeting seafood demand in the future. Globally, it's now accounts for its peaks past 50% of supply. And, you know, we think about aquaculture systems in Australia, but it's particularly important for developing nations where that source of healthy protein is really important. So for these nations, aquaculture, the supply of food is a lot more secure compared to wild catch. And for places like Australia, it means you can really leverage technology and to have a much more direct impact on efficiency and hopefully profits after that. So for Australia, like, obviously the salmonids has been the big growth story, but part of that growth has been the technology and logistical systems. So I really think an opportunity is using some of those things we've learned to diversify the range of aquaculture available. You know, and we see that starting to happen with things like Murray cod and barramundi. For challenges, aquaculture, like many other industries, can have an impact on the environment. And in recent years, it has seen increased scrutiny in this area. And yeah, I think Australia does have a particular affinity for their coastal and marine environment. So balancing the social license aspect is incredibly important. And of course, aquaculture, like many other industries, will be affected by climate change, particularly warming ocean temperatures near the coast. And yeah, so yeah, using good governance, good technology to work through these issues, I think is the way forward for this.
Awesome. Thanks, Harrison. Interesting question around farm profitability, which is, you know, we see from the charts, and we see this across a number of, but pretty much all our industries, where we've got a kind of an upwards trend, but it's jumps around. There's increased volatility, as we see in the profitability series over time. And we just a question, Patrick, around, you know, what do we think the implications for, I guess, long-term viability and financial performance of the sector as we see this kind of increasing volatility in our series?
Yeah, I mean, I think, you know, farmers for a long time have known that farming's it's very cyclical in nature, and, you know, while that volatility is potentially increasing, it's not new to be going through, you know, droughts and good years and bad years. And so I think, you know, the farm sector as a whole has, you know, come up with a lot of ways that can really help make themselves more resilient. Yeah, I mean, the charts I had up there, obviously looking at, specialist farming outcomes for cropping, beef and livestock, but, doing some, mixed cropping things. There's a lot of sheep on cropping farms and, having different revenue streams to manage some of those downturns can really help support people through that. There's the programs that are in place like the FMDs, where, in your good years you can put away some of those savings. And there's we did some data on it last year, I think, about the number of holdings of FMDs. It's quite substantial. So, I mean, I think, it's, going to become more cyclical. It's potentially going to become more cyclical in nature. And, but I think farmers are kind of used to that and, have got a lot of tools in their back pocket to help try and cover that sort of varied uncertainty.
That's a good point, Patrick, because some of the other work that we've done, and it kind of points to some of the discussion Emily was raising about agronomic practices, is that we've seen a trend over time in response to this variability that farmers have been better at managing the downside risk associated with their businesses, and we've seen that kind of improvement over time. And I think those investments that are enabled by things like being able to smooth income, access to WIC loans and so forth, allow the space to refinance and to do something different, have kind of helped the sector go down that path. While we're talking, I guess, a little bit about adjustment and things jumping around, there's a question here about wool, and so Gaby, could you talk us through wool? Is wool predicted to be the production quantity at 100-year lows? And then, so what are some of the things that have kind of led us to the situation, do you think, where we've got those low wool prices and subsequent decisions that producers are having to make?
Yeah, it's sometimes it can be a bit of a mixed story in livestock. Sorry, thank you for the question, Jared. We've seen wool prices come to very historical lows. And even though we're forecasting a slight increase in wool price based on increased demand, wool sector is obviously really exposed to Chinese demand. So I guess any sort of subdued economic growth from China is going to have an impact on wool in Australia. But the sheep flock in itself and the wool flock is in sort of a continual decline. So the sheep flock is sort of transitioned out of a lot of merinos to more sheep meat breeds. So that's also a big transition. You've seen a lot less supply as well as a lot less demand. So only the price is quite low. There's not a large amount of demand coming from China, and then also there's been a big fall in the supply of merinos from the sheep flock. As that compositional shift continues, we're still likely to see that rising level of sheep meat breeds and a fall in the merinos. So they're probably the three biggest impacts they're going to have on the wool sector.
Yeah, one of continued adjustment, I guess, as we also look out over, unless there's some big shifts in the economic performance of some of our major trading nations. A question for Stephanie regarding forestry about the impact that things like severe fire and climate change have come in, and how that might play out, given these very long-lived and not only you're trying to predict how many houses are going to be built in 40 years, you've got all these things that can happen between now and 40 years. How does the sector kind of go about trying to plan for that?
They put a lot of thought into it. So I guess when we think about the sort of risks that the forestry sector can face, the way we're sort of starting to think about it. So this is on the research agenda for the coming year. But the way we sort of think about it is you've got these sort of large-scale, immediate-term risks that are very visible. So it's the bushfires that will come through. And you also have the longer-term sort of, I was going to say slow burning, but that's a bad use of a pun. The slow-moving threats such as climate change. And climate change will have an impact on your growth rates of your trees, and the same with weather variability, and so the high rainfall years and the low rainfall years, and a lot of variability in annual weather events can have a lot of stress on trees, as well as the long-term drying and the climate issues. Bushfires, it poses a different type of risk profile for the forestry sector. And in the near term, as a bushfire goes through, so when large areas of Australia's forests are burnt, some of it will be production forests and some of it will be native forests. So there is the potential that fires will come through and it won't have any impact on our log supplies if it ended up out of the plantation areas. If it is in the plantation areas, your near-term impact can sometimes be a sort of a two-sided effect, in that as you come through, there's got to be a lot of salvage harvesting going on and sort of getting the damaged but not completely destroyed trees out as quickly as possible, milled and into market. So you can counterintuitively have a boost to supply in the very near term after a bushfire comes through. The longer term impact will be on replanting, and you may suddenly have a sort of a really large condensing of the age class of trees. So you'll have whole areas replanted, they're all at the same age, which means that in 30 years' time you've got a massive spike in supply, but from now until 30 years you've got a change in supply. So the plantation managers are very well aware of both of these types of risk, and there is a lot of investment going in at the moment to help with bushfire preparedness, preparation and response, but also looking at genetics, technology, seed breeding, silviculture, very site-specific silviculture. How do you respond to the climate changes that are coming through now?
Wow, thanks, Emma. Thanks, Stephanie. That's quite a dynamic that they're trying to manage.
Yes.
In that instance. Question for Fred. We know that I guess there's been quite a bit of considerable investments in our nuts and some of our kind of exportable fruit sector. But we've also seen some significant kind of investments go in across our competitors. Just as we're trying to, I guess, kind of reach more maturity across those plantings and so forth. What are some of the impacts of some of those other investments outside of Australia, something to have in international markets, and how's that looking?
Yeah, thanks, Jared. I guess I can touch on a few individual commodities to sort of expand on that. Almonds, Australia is a big exporter of almonds, but really dwarfed by California. I know last year they had a really strong crop over there, and when that happens, that generally depresses prices that we can receive. But there's a few things I think in our favour. We do have a low Australian dollar at the moment, which does support our competitiveness. We generally have a freight advantage into key markets into Asia. And I believe the USDA and others are thinking that the Californian almond crop will be pretty high again next year. So I guess, growers in Australia have to rely on our strong Aussie brand and just do as well as they can in global markets.
Excellent. Thanks, Fred. Next question, it's fair game, it's around our live sheep exports and so forth. And the question really is about some of the analysis we may have done about WA specific sheep meat, but we generally do a bit of more of a national take. But we do have some expectations around the sheep phase out and how that trade's going to look over the next couple of years, given that over our forecast period now, the government decision will come in, and I think it's fair to say, as a Gaby, that we expect that decision to be binding in the sense that the trade will stop. Just sort of talk us through some of the dynamics that we're thinking about when it comes to that.
Yeah, thanks, Jared. Yes, as you pointed out with our outlook period, so our agricultural commodities report, our March report goes to 2029-30. So our current report we released today actually goes into detail about the impacts of the live sheep phase out as it comes into effect on the 1st of May 2028. So the most likely impact we will see, as you said, we provide national sheep flock forecasts, so we don't provide specific state-based sheep flock forecasts. But we're likely to see and will see a steady decline in live sheep exports. That's mostly due to the less availability of sheep for export. So we've seen Western Australian farmers transition to more sheep meat production, so more investing in domestic processing and exporting sheep through the sheep meat, and then as well as increasing crop production and area for cropping. And also something that Patrick touched on earlier about mixed farms. So we're seeing a significant amount of move towards, as opposed to sheep specialist farms, more mixed cropping farms. So they're sort of taking advantage of either grain price rise we saw in the past or sort of other streams. So that's probably the biggest impact we're going to see. We're also likely to see a general fall in the national sheep flock in 25-26. Just more destocking activity as well as in other states with dry conditions. So that's also something that we're going to see from that impact.
Awesome. Thanks, Gaby. Emily, coming back to crops, you mentioned higher than average crop values for 2025. Is this purely driven by above average production, or is it also being driven by prices?
Yeah, so prices is something that I didn't really touch on, but it's also prices that are driving the above average production values for 2025-26. So if we're looking at grains and oilseeds, our forecast is for grain prices to increase slightly in 2025-26. So Australian wheat and barley prices are expected to track global prices, and given an expected tighter global supply, global grain prices are expected to increase. And so that comes down to a fall in production, or a likely fall in production in some major producers. So that's, for instance, corn production in Argentina and wheat production in the Black Sea region. We've seen over the last couple of years that global grain prices increased significantly following Russia's invasion of Ukraine, and that price volatility has eased quite significantly with an increase in the exportable supply of wheat out of the Black Sea region. And so that was really because of consecutive record production years in Russia. Now, thinking about what that means for Australia's production values, so with a slight increase in prices, that's not quite expected to be enough to offset the fall in production, but still expected to remain above average because of above average production, like I'd already covered. It's a slightly different story with oilseeds, and for oilseeds, we're looking mostly at canola. Canola production in Australia is expected to remain relatively stable year on year, and that's based on the expected improvement in conditions for both South Australia and Victoria. The other thing too with oilseeds and what's playing out in global markets is that EU demand is really high, really strong at the moment, and the EU is a key importer, a major export destination for Australian canola exports. We're also seeing a bit of a price spread that's opened up between GM and non-GM canola. So the non-genetically modified canola is attracting a premium in Australia and in global markets. We think of Canada as being the major exporter, other major exporter of canola globally, and it definitely seems like Australia has preferential access into the EU, given that we produce non-GM canola as well as GM, whereas Canada mostly produces GM canola. Yeah, so that means that with the higher prices and relatively stable production for canola, that we're forecasting that the gross value of canola production will increase in 2025-26. And given canola has performed really well in previous years, it's sort of remaining at that kind of 5-year average level.
Thanks, Emily. A couple of questions to do with farm profits and distributions and so forth. And I know we've got some data on this, but I might have a tag team with an answer with you, Patrick. But there's a question here about, do we have any data on inputs into livestock, for example, feed, which I know we do, and and we had to make some comments about where we think some of those prices and costs will go, but also about the distribution of farms. And this is something that we can actually leverage with our survey, that we've got good detail on the distribution, and whether there's any kind of facts that you've got to hand about, well, what in livestock sector, like what does the distribution look like across our different farms?
Yeah, not sure I've got the stats on hand about the livestock distribution, sorry.
How about you handle feed and I'll have a chat about
so
distribution.
What was the first half, sorry?
It's just about the feed costs and how we expect that to look at as one of the kind of input bundles for livestock.
Yeah, I mean, we're expecting the feed and fodder price to come down, and I don't think, obviously, that's becoming a big part of, the getting your livestock ready for sale, is that feed cost. I think I might get Fred to help me out here as our macroeconomist who devises some of our feed indexes to sort of talk about some of the drivers of that potentially.
Yeah, I mean, I guess the big ones are dairy farms consume a lot of fodder. All livestock farms consume a lot of feed grains as well. We touched on the intensive pig and poultry earlier. I believe, fodder prices have been pretty elevated still last year, and that's probably because of the dry conditions in some regions, I would think. And so we're sort of essentially forecasting a more of a return to normal of sorts. And then, yeah, as Patrick said, feed and fodder being a major input for your broadacre livestock, that obviously flows through to profits. But like you said, the distribution story is important. It really depends how many animals you have, what else do you produce, revenue streams.
Yeah, and that's one of the interesting things that we can pull from our survey. I think it was last week, or maybe just the week before. We just released our latest update of the distribution of I guess, income, profits, and cost rate of returns across different sectors. We split them up into, like I say, in livestock for beef and for sheep and so forth into deciles, and you can look at the difference between, I guess, the top decile and how much income, their cost structure and the like, and the bottom decile. And for some industries, we see much more kind of uniform spread. And so dairy is one example that stands out, where we see the kind of structures across the industry, across those different deciles, being much more similar. But beef is one in particular where we see quite a bit of difference. And so we've got the northern kind of cattle industry, very large operations, very different kind of input mix that goes into that, different kind of profit structure and the like. And then we also have a very, I guess we would call long tail in the beef industry, where we've got a large number of smaller producers with very different kind of cost, income and profit structures. And that's something that varies by industry. And we see also in the cropping sector one where we've got a bit more uniform in that sense. And I think that kind of ties back into some of that, discussion we had this morning about productivity and how we roll out different types of innovations, ideas and so forth across such a different structure. But I'd welcome, happy to take offline, but also jump on our website under our farm performance stuff. There's quite a lot of data that you can download and get into, which will hopefully answer the questions. And if they don't, we'll more than happy to kind of jump in for more. So, moving on now, a question about plant-based protein, which I think is an interesting one, and maybe I'll open it up a little bit more broadly as well. We know, how do we think the kind of demand for market for plant-based proteins, and for us, given agriculture such trade exposed, it's not just about domestic markets, it's internationally. How do we think that's going to influence some of our output and land use? And do we expect that to flow through to prices? And do we think, I guess on the livestock side also, is there any kind of implications?
So who's that directed to?
Well, it's
all of us.
All of us, yeah. Whoever wants to jump in. So.
Well, I mean, I guess it depends on what the product is, right? I guess there's the idea of lab-grown meats or plant-based products that are made using, say, pulses. So, I mean, potentially, if we're seeing a really big change in consumption around plant-based proteins, and with that, potentially an increase in production of pulses in Australia. I mean, I know that, with some of the pulses produced in Australia, that there are some kind of direct grower contracts with producers and processors to, I guess, make these plant-based proteins. So, I mean, that's just from the cropping side of things, and of course it's got much bigger implications for the livestock sector.
Yeah, it's interesting because a lot of the consumption trends we see in regards to Australia, obviously we have very elevated consumption of pigs, poultry and eggs. There's obviously been more demand for leaner meats, so we've seen that happen. There's continues to be sort of a consistent demand for beef. Obviously, I think that's more of just a cultural thing. Aussies like to eat beef. So a lot of the transition shifts we see in consumption trends sort of tend to are more impacted by, I guess, price trends. So the increased price of red meat will obviously shift people towards consuming lean meat or chicken meat or whatever. But we are also seeing more of a shift, I guess, away from sort of this lower lamb and mutton consumption. And I think that might feed into the trend about plant-based consumption. But we tend to see beef as more steady, rising in pigs, poultry and eggs, and then a shift sort of away from lamb and mutton.
Thanks.
Yeah, Jared, I remember we did look into a little bit at some of the domestic consumption, the scanner data in Australia, and you look at alternative proteins, yes, the consumption's gone up a little bit, but it's very hard to work out if that's displacing, traditional protein sources, and it perhaps isn't. And I guess, with producers will respond to price signals, and if you can value add your product and people want that, that's great. But it might be more of an export story in the short term, I think.
Yeah, and I think it comes back to, no matter what the product, I mean, the figures that I got stuck in my head, which I know are older, Australia produces about 1% of global agriculture production. And so, there's big, producers, but also big demand outside. And so as long as we're selling the product, that consumers want, they might deliver still very strong demand for our beef. But there's room for, this substitution to occur across consumption worldwide and may not impact our production, or may impact it in different ways than what we think. Question back into rock lobster. Now, someone's got a keen eye. So the forecast value for rock lobster doesn't reach the previous high despite China reopening. What's the cause of that?
Yeah, well, when we look at these things, we have to, I don't want to say be conservative, but we do note that China is going through a bit of an economic downturn. And our latest source of data, we have seen quite high prices. So I believe the latest export prices were around that $80 a kilo, but that is for December. So the build up for Lunar New Year, where demand is quite high. So I think we'll definitely see great prices in January as well, but then it's really a watch point for the months after that. Also as well, Australia's dollar is really low at the moment, so great for export competitiveness. But as that increases, we do expect production values in real terms especially to decrease a little.
Excellent. There's a question which I'm happy for anyone to comment on as well around the US, and maybe I'll kick us off. The question is are we expecting US tariffs to impact agriculture in the immediate term? And are we starting to kind of think about these risks when we come to look at our markets? And I think this is really more in the livestock space, really for our kind of bilateral trade with the US. And obviously we send beef and lamb into the US, and they're both valuable markets for us, particularly now for lamb and for beef, given where their herd is at. One of the things that we've kind of observed, though, is the dynamics of the US herd will drive demand, as you were saying, Gaby, over the long term. But I think, does that, I guess, give us some level of kind of confidence, or maybe the confidence is the wrong word in this context, but I guess when we balance the risks, when we think about the balance of risk lie, does that give us some kind of sense of where we think the balance of risk might lie?
Yes, so thanks for the question. And also I think obviously the impacts of tariffs will be seen depending on the form, what form they take, and Fred can expand that further on that. But just on the livestock sector, the lamb is US is our highest value lamb market, so obviously that's very important, and also a huge market for beef. And as the beef, so the US herd has been destocking over the last few years, and obviously there've been some conversation about them entering a rebuilding phase. So the current US cattle herd is the lowest it's been since 1951. So we're forecasting that they will go through a rebuilding phase in 2025 and 2026, and we're likely to see an impact or an increase in US import demand. So to see that continued, I guess, as you said, it's not necessarily confidence, but we're likely to see continued demand for Australian beef exports. And then on the lamb and mutton side, we've seen over the last few months quite a high increase in monthly exports to the US. And I guess that's because Australia is the largest sheep meat exporter, and they also get sheep meat from New Zealand. But as the New Zealand flock decreases, Australia will then sort of maintain a higher proportion of exports to the US. So that's basically the two main markets that will be impacted. And whether they are impacted depends on the form the tariff takes.
Thanks.
Yeah, I guess something to add on tariffs, and it was covered nicely in the first session, I think, with uncertainty is a feature, not a bug, of the current US government administration. But I also think that the advisors there and things are pretty well aware of inflation and food inflation. And that's not just a case in the US at the moment, it's a case in Japan, it's a case here. And so we saw with tariffs last time and in the past, and modelling done by those in the Australian government as well, that tariffs generally do increase inflation and increase costs along the supply chain. So, administrations implementing tariffs do have to weigh that up, and I think, it remains to be seen over the coverage and the scale of any potential tariffs in future.
Could I mention as well just what some of the implications might be for global crop markets? So since the previous China-US trade tensions, when Trump was last in office, we've seen some significant changes in global trade flows for crop exports. So China is now less reliant on the United States for imports of, say, soybeans. And we've seen Brazil has become a major player in global markets. So China is now importing, the share of Brazil's imports to China are now a much larger share than what they had been. And that goes for both soybeans and corn. But I think the one for us to keep an eye on will, of course, be Canada and canola. So Canada's canola exports to the United States, well, the US is a major market, but with that, we're also seeing that there's a much bigger expansion now in the domestic crushing capacity within Canada. So we're seeing more and more that they're not exporting as much and instead processing domestically. So that's also something for us to be keeping an eye on. And also already mentioned that the kind of market dynamics are a bit different when it comes to canola for Australia compared to Canada. Yeah,
thanks, Emily. And I think that's an excellent point that you raised, that the second round effects are often quite interesting as we see this kind of dance of different global powers and the changes that has on trade flows and the implications and so forth. And I'll give a plug to our session coming up, which will kind of go into some of these aspects about how that dynamic is changing. But it's important for markets, and it's also important for the type of product that we're selling. So when we lost access to China for wine, very specialised products, it was more value added, it was directed towards the market, much harder to switch between markets. Whereas for barley, we hadn't, I guess the tariffs in Australia being locked out really shuffled the deck chairs, but we still had markets. It's much more of a primary product. So that was kind of a dynamic that's important when we think about these various impacts. Now I think we've got maybe time for one more question. And there's a range of really good ones, but there's one which I can't go past because of the way that it's framed. My kingdom for an egg. When are we going to see them back on the shelves? And so, do you have any comments?
Yeah, so with the recent, we've obviously seen localised outbreaks of bird flu in Victoria. So we've had 4 cases, 4 cases. But they're obviously quite localised and all linked. They're about the same producer. And last year we saw egg prices obviously increase with a fall in supply. So I think using ABS monthly CPI data, it rose by 11% to December 2024. So we obviously saw a fall in supply and therefore a big rise in price. So we are likely, I think our forecast for 25-26 is we're looking at there being a fall in the price and an increase in supply So hopefully we'll see that happen. Obviously, it's quite a dynamic and changing situation with the bird flu outbreaks, but we have a significant amount of biosecurity policies and plans in place to ensure steady supply.
Fingers crossed we'll have the kingdom and the egg back with it. So with that, I think we're right on lunchtime, but I want, if everyone could to take the time to thank the wonderful analysts for their insights. You can see the quality of the people we have that kind of delivers the work that we put out. But we're all around for the next few days, so if you have any other questions we couldn't get to in the conference, please come and follow up with us directly, and we'll bring session 2 to a close. Thank you.